Hey guys, I want to do a short video on what I look for failed breakouts or failed breakdowns. And so I'm going to go over three things that I personally look for. First one is kind of a balance rule and or price action kind of rule. Second will be kind of like ICT. And then third is kind of more just like overarching momentum and what I'm looking for. And so I'm going to be drawing here on Paint. And so it's not going to be as good as my normal drawings on iPad since I'm just going to be using the mouse. But so the first one I look for is, let's say we're in a range, we're going back and forth, and then the balance rule would say if we're going to anticipate a breakout, right, we want to see a build in time or volume on one side, and then we would anticipate a break of that side. And then in price action terms, that would be a buildup, essentially. So if we're anticipating a break to the upside, we want to see a buildup. And that would be indicative of a break to the top side. And same thing for the bottom side. And so why do I say this? Because this is indicative of a good breakout. For good breakouts, we want to see buildup, whether that be price action, time, or volume. But if we're trying to anticipate a failed breakout, we want something that has no buildup. So let's say we just go straight up right here. I would be more so anticipating it to fail than I would if we had a buildup and then a breakout. Same thing for the bottom side. If we just go straight down, I would more so anticipate a fail than I would if we have sort of a buildup at the lows with time and volume on the profile. So that is the first thing I look for. Second thing would be sort of the ICT concept, where we have a fair value gap created from a big up move or down move. So let's say we have this structure, and then right here we have a fair value gap in between. And if you're looking for other terms, if you're not familiar with ICT terms, this would just be an imbalance where we moved up super quickly, or singles, right? And this would often on the profile look something like this, where we have a low volume node where that imbalance was because we moved so quickly we weren't able to do a ton of volume or spend a lot of time there, hence the singles. And so the reason why this becomes a good spot to look for failed breakdowns or failed breakouts is because we have these lows. People tend to put their stop losses here below these lows, and then this imbalance fair value gap is where we moved up so quickly people were probably not able to buy and we didn't do that much volume. And so people are going to be waiting down here in this imbalance, in this fair value gap to buy, and people have their stops right here and will be looking to short below this. And this would be in ICT terms an inducement, which is essentially just a bait for people to get stopped out and go short. And so what often happens is we will move into this area, stop these people out, shorts will get in, and buyers are waiting in this imbalance, and then we'll move up and trap the shorts. And so that's a good spot to look for failed breakdowns. And if we flip this upside down, same thing, we have an imbalance down. If we move back over the highs into that imbalance, it's a good spot to look for a failed breakout. And then the third concept is essentially just momentum. If we're in a overarching downtrend on a smaller time frame, I will be looking for a high and then a fail to move over that high, right? And then same thing, uptrend, want to play the momentum, smaller time frame, we have a low, I am more willing to buy under that low, or buy once we fail to break down and come back over, right? And the only time I'll really go against this is if we're, say, super overextended to the bottom side, then I might look for a move under the low or over the high in an uptrend instead. But that's only if we are very overextended. But if we're not overextended, in a downtrend, generally you'll look for failed breakouts, and in an uptrend, you'll look for failed breakdowns. And so I'm going to show you kind of a couple examples of the ICT version of this on real charts. So you can see here is a couple examples. Down here we have these inducement lows where people's stops are going to be, people are going to look to short below, and then we have this fair value gap, super quick move up. And so what happens, we take out these lows and we go into the fair value gap, find buyers, and go up. Same thing here, fair value gap, equal highs where people are going to have their stop losses. We take out their stop losses, find sellers, trap, and then go down. And so those are often very good spots to look for failed breakouts or failed breakdowns. And I can show you, I was expecting this one down here at the lows right here. As you can see, I was saying deviation, which is essentially the same thing, failed breakout or failed breakdown, where we deviate below. And so that's why I was expecting a deviation below, and then you can see real time deviation happens. We go below into that zone, come back up, and then from there we made a very good rally. And so failed breakouts and failed breakdowns have become my favorite setup, essentially, because as I used to trade technical analysis, it started irritating me how often I was seeing these. And then I kind of learned the nuance of when to anticipate and when to not anticipate these failed breakouts or failed breakdowns, because you don't always want to try to anticipate or fade the moves, but there are certain cases in which you want to, because it's a lot more favorable in terms of the momentum of the overall market and just the conditions where we're likely to trap people.